Hey everyone, this is Purti and whoa. What a market we had over the past week. It's been named the David versus the Goliath story where the little guys are going up against the giants, the squeeze of the century and the steal of the century. In case you don't know what I'm talking about, it's the story of GameStop. Before we talk about the story, let me introduce three characters of this play. Enter the company GameStop. To paint you a picture for those who don't know, GameStop is a brick and mortar retail chain store that sells computer and console games. Over the years, as games have migrated to online retail stores like Microsoft Game Store, PlayStation Store, Amazon, etc., GameStop has been losing business and hopes of its recovery has been fading. Enter the hedge funds. As GameStop was going out of business, some giant hedge funds in the Wall Street like Melvin Capital shorted GameStop with the hope of driving the stock price to almost zero or to a few pennies a share. The plan was to cash in on the shorts, buying back the stocks for a few pennies. This plan was just hit by a freight train. Enter the WallStreetBets. WallStreetBets are an online community in Reddit where people join together to discuss stock ideas and trades to play in the stock market. It's a brilliant forum of mathematicians, physicists, workers, teachers, and people from all walks of life joining together, learning of opportunities in the market and exploiting those opportunities to make some profit. The prologue. As of 18 December 2020, GameStop was trading at around $10 a stock and the Wall Street hedge funds were short on GameStop. So much so as to short 140% of the stock. One may ask, how can the shorted stock be 140% if the max stocks available are just 100%? Well, you see, if I short one stock, I borrow from broker 1 and sell it to broker 2. And now you with broker 2 decide to short the same stock. You borrow from broker 2 and sell it to broker 1. At this point, though only one stock has moved around between broker 1 and broker 2, you and I both respectively owe our brokers one stock each with a total of 2 stocks owed. The ratio of shorts to the outstanding shares is known as short interest, which in this example is 2/1, that is 200%. Enough of theory, and now back to GameStop being at short interest of 140%, that is being heavily shorted. Typically, when the short interest is this high, the outstanding shares are quite less, leading to shortage of stocks on the buy side. The plot. The Wall Street Bets community figured this out and thought to make money off of this, aka screw the hedge funds. The mechanics of the plan is to raise the stock value by buying large quantities of shares, hence increasing the stock price. And having a community of 1 million people really helps a lot. If 1 million invest $1,000 each, we are looking at $1 billion injected into the stock to raise the stock price. The hedge funds must then buy these stocks at a higher value than the price they shorted at to cover their positions, hence encountering a severe loss. Even if they don't want to close out their positions, the brokerage forces them to, as they may run out of collateral or cash to buy the stock if it rises higher. This is what is known as margin call. If a margin call occurs, then more buying pressure happens and the stock reaches even higher. And the more shorts are forced to close their positions. This phenomenon is known as short squeeze, the mother of all bulls or the perfect storm for the shorts. The execution. As GameStop rose from $10 a stock to around $40 by the 21st Jan, they publicized this move by using words like revolution, steal from the rich, etc. And as a result, lots of mom and pop investors and even kid investors having low account balances and more importantly, those who were screwed by the Wall Street during the 2001-2008 financial crisis saw this as an opportunity to mess with the Wall Street guys and take the revenge. It's a really smart way to take the revenge, I must say. Come 26th Jan, the stock price rallied to $150 a stock. This led to an explosion of the Wall Street Bets community, which increased their subscription from 1 to 2 to 3 million, and currently they are at 7.7 million people. In subsequent days, the stock rallied all the way up to $483, and as of yesterday, it is trading at $325. So within a week, the stock moved from $10 to $325. That is a 3000% increase. This has now become a movement, and more people are interested in these stocks as time goes on. Let's look at the possible scenarios of how this will play out in the next video. But for now, let's have a look at the mechanics of the short squeeze. Like I mentioned previously, if the stock price has to rise, one way is to buy the stock directly. But this is a slow way to architect a squeeze. There is another way by purchasing short-term call options. I know I haven't made videos on options yet. I'll get to that soon. But for now, all you need to know is, if I buy a 1-week expiry call option contract at say a strike of $10, then at the end of the week, if the stock is trading at a higher than the strike price, let's say $20, the broker will purchase 100 shares per option contract you own at the strike price. That is, in this case, 100 shares at $10 each. The options contracts in this case were about 1/5 the price of the stock, hence making it more affordable for retail investors. Because these stocks were heavily shorted, there weren't enough shares available in the market to buy. Hence, the brokers had to close out some institution shorts via margin calls. And the price they paid was much higher than that of the trading price. On 26th Jan, the market closed GameStop at $148, and the next day morning it opened at $345. Yikes! There is also something known as the gamma squeeze, but I will cover that more in the options videos. Enter the media. The media started covering the story and it just went viral. More people with a view of making a few quick bucks came into GameStop. Trading platforms like Robinhood, TD, Ameritrade were put under severe risk. You see, though we buy and sell stocks in real time, there's a clearinghouse that takes 2 days to settle the trade. For those 2 days, the trading platform needs to put up the money as collateral for the trade to go through. The trading volume on the brokerages was so high that they were at risk of insolvency due to lack of collateral. Hence, they stopped trading for a few heavily shorted stocks. This now became Wall Street screwed the people movement, and political entities interfered and both Republicans and Democrats joined hands, and that's never happened before. Who thought GameStop would unite Congress? The way things stand as of now is that the SEC has gotten involved. Republicans and Democrats are going to hold an investigation for malplay. And this euphoria or speculation, call it whatever you want, is getting into a bigger and bigger bubble. Though I always say I'm not a financial advisor, I do have some advice for you. If you're new, use this as a learning opportunity and follow this news. Learn about the internals of the mechanics of the stock market, as what's unraveling now will probably happen once in a lifetime. We are actually witnessing history in the making. As for investing in GME or AMC, it is completely up to you, and I personally don't have any positions there. Let me know what you think and leave your comments below. If you like this video, don't forget to like, share and subscribe, and hit that bell icon for more videos on financial literacy. Thanks for joining me today, and I'll see you all in my next video. Bye-bye.